The next example we look at is a company that makes three products for water skiing: life vests, tow ropes, and water skis. We have full capacity of 65,000 direct labor hours available to us each year. And our marketing department has released their sales projections for the upcoming year. Those sales figures exceed our demand of our direct labor capacity. So we need to decide how to best use the amount of direct labor that is available to us. And how we do that is we look at the direct labor hour, the contribution margin per direct labor hour. So we have information about our three products, and we need to figure out what the contribution margin per unit is. So remember, contribution margin is sales minus variable costs. Our variable costs are direct materials, direct labor, and the variable overhead. Again, in short-term special decisions, we do not consider fixed costs because fixed costs are unavoidable and we cannot get rid of them. We have to pay them regardless of what decision we make. The next thing we want to know is what are our direct labor hours per unit for production? So we see that we have an average of $10 per hour that we pay our employees. So at $20 an hour, or $20 total cost divided by $10 an hour, this takes 2 hours to produce. And for tow ropes, we have a cost of $10 divided by $10 an hour gives us 1 hour of production. And for water skis, direct labor cost of $80 divided by $10 an hour tells us that water skis take 8 hours to make. We then divide our contribution margin per unit by the number of direct labor hours it takes to produce that to get the contribution margin per direct labor hour. As we can see, life vests and tow ropes have a higher contribution margin per direct labor hour than water skis. Last, we want to look at how many hours are required to meet our marketing demand. So we have 25,000 life vests times 2 hours per life vest. And we have 15,000 tow ropes times 1 hour per tow rope, and 5,000 water skis times 8 hours to make each water ski. So our total hours required for our marketing demand, we add those all up, is 1,005 direct labor hours. However, we only have 65,000 hours available to us for production. In that case, we should focus on all of our energies on life vests and tow ropes. We can meet the demand with the 65,000 hours that it takes to make life vests and tow ropes. We maximize our contribution margin per direct labor hour, which then maximizes our potential operating income. The second part of this question says, what if we need to make water skis in order to support the demand for the life vests and tow ropes? So they're complementary products. You've heard about those in economics. So they support each other and people come in to buy them together. Then what do we need to do? In that case, we would need more information. We would want to know how much of that demand for water skis was driving the demand for life vests and tow ropes. Is it enough to impact our total sales that we want to continue making water skis. If what we find out in a marketing analysis is that yes, it absolutely is a complementary product and we need to continue to make all three, then we would still want to structure our hours to make more life vests and tow ropes to maximize our contribution margin per direct labor hour than we do of the skis. We wouldn't try to meet full demand of the skis, but we would want to make some skis in order to satisfy that that's available as a complementary product. Our next decision is a make or buy decision. So companies can decide if they're going to outsource products or portions of products from other companies. What they have to consider if they decide to make or buy a product is what is the cost to purchase it versus what is the cost to manufacture it. What other things can we do with the factory capacity if we're no longer making this product? What does our supply chain look like if we buy it from the outside? As it stands, we're currently making it in-house, so we know when it's available and we control its quality. If we buy it from a supplier, we lose some of that control of quality, and we can't guarantee that it's always going to be available to us when we need it. Those are some of the other factors that we need to think about, just as costs. So we have information about this electric motor here. We need 12,000 motors per year. We can purchase it from an outside supplier at a cost of $21 per unit. The cost of manufacturing the motors is $35. Now, initially, we would think, well, of course, we're going to save $14 per unit if we buy it. We should absolutely do it. However, we need to think about our unavoidable overhead costs. Remember, we can't get out of overhead costs just because we stop making this motor. Now, it does give us some information here that we can eliminate $6,000 of our fixed costs, but is that enough? So we want to look at what it costs to make the motors, what it costs to buy the motors, and what our incremental analysis is. The incremental analysis is the difference between the two decisions. If we make the motors, we have direct materials of $96,000, direct labor of $120,000, variable overhead of $90,000, and fixed overhead of $114,000. Doesn't cost us anything to buy those parts. Because we're making them in-house. So our total manufacturing cost for making the motors is $420,000. If we buy the motors, it says here, we eliminate the materials and direct labor costs, but only 75% of the variable overhead costs. We're also going to eliminate $6,000 worth of fixed costs. So we have 0 direct materials, 0 direct labor. We have to have 25% of the variable costs because we can only eliminate 75% of them. So we still have 0.25 left times our variable costs. And our fixed costs, we can eliminate 6,000. So take our fixed costs minus 6,000. And that is our new fixed cost total. Then we also have the cost to purchase 12,000 motors. Well, the cost to purchase $21 times 12,000. So if we add those together, the cost to buy the motors is $382,500. So when we look at this incremental analysis, remember it is the difference between the two options. If we buy the motors, instead of manufacturing them in-house, we will save $37,500, which is a good deal. Now we see that if we purchase them from an outside source, the factory space previously used to produce motors can be used to manufacture an additional 4,000 power trimmers per year. Power trimmers have an estimated contribution margin of $8 per unit, and the manufacture of additional power trimmers would have no effect on fixed factory overhead. Does this change our make or buy decision? Well, so we have the extra power trimmers. We can make 4,000 of them times a contribution margin of $8 per trimmer. So we're going to increase our contribution to operating income by $32,000. Then we have the buy motors from outside vendor. That is going to save us $37,500. The total savings then, an opportunity cost for buying the motors from an outside vendor in this case, now raises to $69,500. So everything is better all around if we buy these from an outside vendor. And our last decision is whether to sell, scrap, or rebuild inventory. So we have a digital camera. Our newest model is very popular, but it has made our old model obsolete. There's very little demand for it. So we're looking at two different options for this camera. One of those options is to sell them to a discount mail order company at a total price of $1.9 million. Our other option is to rebuild them. So we can, for an additional cost of $6,000 per unit, we can make changes and updates to them that then we could sell them to camera stores for $1,000 each. It also tells us that the old models had a manufacturer cost of $525 per unit, and the cost of manufacturing new models is $700 per unit. So now we have to decide what is our relevant information and what is not relevant to this decision. So what is relevant to this decision is what we would achieve if we made the decision. So we could sell them for $1.9 million. That's extra income to us that's relevant to our decision. What isn't relevant to our decision is that the mail order company would sell them for $480. That $480 doesn't make any difference to us because that's not our proceeds. Other irrelevant information in this decision are the manufacturing costs. So it doesn't matter that they cost $525 per unit to manufacture. Those are sunk costs that we can't recover anyway. So it is irrelevant to our decision making. So if we're going to do this incremental analysis, we have to sell to a mail order company. If we sell to a mail order company, we make $1.9 million in sales. There are no additional costs for doing that. We would just sell them as they are. So our incremental benefit is $1.9 million. If we convert them to the new model, we can sell them for $1,000 each. So our sales revenue is $1,000 times 5,000 old cameras. Our incremental manufacturing costs are, we have to pay $600 to convert them. So 600 times 5,000 cameras. So our cost benefit if we convert them, is $2 million. If we convert these, we increase our income by $100,000. So we have the potential to make more money if we convert them. The other non-financial things we would have to consider is if we take the time to rebuild them, does that detract from the time that we could be building new models that we would just get full money for anyway? So we would have to think about our capacity and if we even have the capacity to build them.